Welcome back, everybody. I'm Dale Creed Francis. As you can see, my co-host Ryan Litfin is absent from this episode of the YouTube channel for us. He had to be out on business, so I'm taking it. I wanted to bring you up to speed on our latest economic war report, which is Index Danger Zone. And we did get some listener emails that came in, and contrary to what Ryan claims, people do not compare him to Tom Cruise. I actually think he fits more to the goose in the Top Gun, but he thinks Tom Cruise. But anyway, so the index danger zone comes from this. Many people believe right now that indexing is just an easy, simple, cheap way to go, diversify. Really, it's none of those things. To summarize what we did on the show, index funds are expensive. I know that's contrary to what you think. You think there's a cheap expense ratio, but we did our own research, pretty thorough, and we found out that the look-through expenses into index funds averaged about, get this, 4.2%. So you say, how can that be? Again, marketing. The index marketing is in the hundreds of millions of dollars a year right now to make you believe that they're really cheap. If you want to know more about what fees that you have in an index fund or an ETF, go to indexdiscovery.com or etfdiscovery.com. You can go to what'sinyourportfolio.com and look at all the different ones that are free for listeners of our show and part of the Fortitude Nation. Now, the second thing is that index funds are not diversified. People think, oh, I'm diversified, I'm buying all these different pieces of the market. It concentrates risk. In fact, it's not diversified at all. Advisors tout the words diversification because they know that sells. But in fact, it concentrates the risk, and it's not diversified at all. 10% of year-to-date gains in the index are from just 5 stocks. So additionally, it should be noted that as more and more speculators turn to index funds, really it pushes those prices higher. The index fund is not really investing, it's speculating, and that's a point we're trying to make. Dr. John Hussman said this. He said, I don't believe that what passive investors are doing here actually represents investing in any valid sense of the word, but it does address the psychological desire to experience the same fluctuations that others do. I can relate that to the old term misery loves company. There's a saying, the only thing that people hate more than bad news for themselves is good news for their neighbor. So that's kind of the thing where they'd rather lose in a big group than maybe do something different than the masses. And you got to remember to be careful when following the masses, because sometimes the M is silent. Let you absorb that for your own. Index funds are risky. Again, how can that be? You think I'm diversified, that should lower my risk. Look, we say on the show a lot, the mind is like a parachute. It only works when it's open. Just think about it logically. Index investing has no risk protection at all. When you are buying the entire, say, S&P 500, that all seems to work really well when it's going up, and it works horribly when it's going down. I've talked to younger investors who don't necessarily know any better. I think older investors have a better memory of this, but I talked to a 30-year-old who said that he had it all figured out because he's just buying the index and man, he's making money. I said, how long have you been investing? He said 8 years. So he's experienced nothing but basically up market. So in reality, a better way to invest is to know what you own and have those layers of uncorrelated investments. That's the best way to have your total portfolio more protected than just passive index funds. And in conclusion, we really believe that investors are taking a great deal of risk with index funds. Thanks for watching, and we look forward to joining us next time.